Hey Salman, how are you doing?
Hey, Olivier, how's it going? What are you up to?
I'm good. I'm finalizing a case on credit that I intend to present to the next weekly meeting.
Interesting. So, what's got you concerned about credit?
Well, I'm concerned because there has been a number of factors that were supportive in the past that have now turned, and that makes the case for credit much less favorable in the short run. And I think we really should consider trimming the position from the current overweight that we have to a more neutral sort of positioning.
So, don't you think that the macro should be fairly supportive? We've seen the global economy recovering quite strongly, basically V-shaped. Our nowcasters, right, they're saying the same thing. They're seeing very good growth environment. And then obviously, you've got central banks in there pumping in a wall of money that doesn't seem to be going anywhere anytime soon. So to me, it seems like a pretty benign environment for credit, no?
Yeah, definitely, you're right, and that's why spreads have compressed so much since March. If you remember back then, at the trough of the crisis, US high yield spreads, for example, had reached 11%, and they are now back to 350 basis points, and that makes a stunning 26% total return from trough. But less than macro fundamentals, it's more on the sentiment and valuation fronts that I'm getting worried, and especially on three elements. The first one is defaults. They are expected to rise towards year end, and we are now expecting low double digits defaults in the US for US high yield, slightly less so in Europe, but that's probably more bad news to come from that front. The second element is supply and demand mechanisms. Supply is said to remain pretty elevated given the cash needs that companies have coming from the sanitary situation, while demand is probably expected to fade as well.
Okay. One of the things I've been looking at, I'm sure you looked at as well, is you look at positioning indicators. Those are basically showing that investors are back to their pre-crisis levels or above even.
Absolutely, you're right.
So then the last point you raised was valuation. What's the concern there?
Well, valuations is twofold. First is carry, obviously, given the current level of spreads, and that is less attractive, and that makes expected returns for the asset class in the next few months much lesser, roughly 1% for high yield, for instance, and that's not even cushioning against the slightest upward move in spread. So basically, long story short, I think we had a planet alignment between macro sentiment and valuation in the past that we don't have anymore. And that's why we should probably start trimming the position from a more neutral level.
All right, that makes sense. I think also, the rising geopolitical risk that we're seeing, plus second, third waves of coronavirus, could be a real risk.
Yeah, absolutely. And anyway, we'll start digging in the discussion in our next weekly meeting, so stay tuned.